We are back with our weekly market review where we keep an eye on the downside to see if any potential correction or crash in the market is coming. No one likes to look at the downside and manage risk. Everyone's trying to pick the next huge stock. So we help do it for you. So in the first part of this video, we of course are going to go over the markets and look at the probabilities of where things will go from here. And that's where we'll go over if we'll see a crash or correction. And then we'll get to some advice from one of the greatest traders to play the game. And it's really important for the type of environment we're moving into. After that, we're going to talk about an extremely popular stock, especially on YouTube. People have been going crazy over it and they've been buying. So a ton of retail investors are in this stock, but now it's looking pretty bad and it actually looks like a good short candidate. So you're going to at least want to possibly take your money out of there. And then we'll finish up with a huge trend that's getting started and we're going to talk about how to play it. So let's jump into it. First up right here, we got a 90-year chart of the S&P 500. Take a look at this. Nice to see at the beginning of the new year. And what exactly do you see here? Well, the obvious trend is up and up and up. So you guys know about our Fallible strategy. It's a long only momentum strategy. And what happens is a lot of people come in and they ask, hey, why don't you short? You can make a ton of money shorting stocks. Why are you long only? Well, it's true. You can make a ton of money shorting stocks, but I'll tell you what, it is way harder than buying stocks. And a big reason why is because of this chart right here. The general trend of the market, at least in the US, is always up. So just by buying a stock instead of shorting it, you're putting the odds in your favor. And shorting a stock is not just the opposite of buying a stock in terms of the mechanics and how the trade plays out. That's what a lot of people confuse. Like I said, much harder to short than it is to buy. So when we look at our strategy, yeah, we could make money shorting, but it just makes more sense to stay long only, especially when we're dealing with momentum. Way easier, way less stress, and you still have fantastic returns. It's also harder to systematically short because of the way price moves on a stock when it's moving lower than it is to systematically go long. And the difference between going long and going short, that's a whole nother video. But I just wanted to show you with this chart why it does pay to buy stocks over the long term. So even if we do see big corrections and big crashes, the market usually turns around and goes higher, at least in the US. And I say that because there's differences in different countries. But again, that's a different video. Moving on to the market right now, our aggregate sentiment and positioning indicator is coming off a 90th percentile reading. And when we say our, and you see me reading off this page, and I read a lot on this website, that's because it's coming from Macro Ops. This is our global macro research firm. So that's most of the research I use in these videos. So this is one of the indicators that we have built in Bloomberg. And you can see this red line right here is hitting highs. It's hitting this dotted red line. And that's our sentiment and positioning indicator right there. So with a 90th percentile reading, it's basically saying that there is significant trend fragility, meaning we could easily see a correction. Now, our shorter term indicators suggest the path of least resistance is still up, meaning there's still that upward bias, but the market is likely to hit a speed bump in the second half of this month. So you got to watch the tape and keep your eyes peeled. So a few things here, sentiment and positioning. Like I say in every one of these market reviews, we track that so that we know where all the money is moving. So right now what's happening is that all the big money is in the market already. There's not much cash on the sidelines. So when that happens, there's only one way to go, and that's down because people can only sell, right? So when we see that positioning, everyone in the market, it's actually a bearish sign. Same thing can be said of sentiment. If people are super bullish because they have their cash in the market, that's a bearish sign as well, because you always want bearish people that still need to convert into bulls so that they could put their money in, buy stocks, and push prices higher. So you'll see us in every video track this sentiment and positioning. And like Alex says here, who's our lead researcher in Macro Ops and who wrote this, you gotta watch the tape. And that means always watch the price action, because we could do all this analysis, all this macro research, but at the end of the day, we're not smarter than the market. Wherever the price is going is where the price is going. And you gotta react to that, and you gotta manage your money based off that price. So it's just like Paul Tudor Jones says, price is king. That's our motto here too, because all the complicated analysis and what everyone is doing is gonna get distilled into exactly what the price is at that moment. So always follow price at the end of the day. And a good indicator of where the market is gonna move is the Semiconductor Index. So they're actually breaking out of a multi-week wedge right now, and you can expect them to lead on the way up as well as the way down. So that's another thing you can do. If you know what sector is hot and what sector is leading the market, you can track that sector and it'll usually give you a signal ahead of when the market turns. So if you see semiconductors coming down, you can bet that the rest of the market will follow soon. So it's the same thing in our Fallible strategy because we're invested in the highest momentum stocks. So when those start stalling or turning around, that usually happens while the rest of the market is still going higher when you look at the index. And that diversion between our high momentum stocks and the market, that kind of signals that the market will turn around soon. So there's a bunch of different leading indicators you could use. Those are just a few. So once again, going back to the S&P 500, and this is more of our research. So what's going to happen with stocks? Well, long-term, a reflationary Fed and US government bent towards stimulus suggests that we'll see higher risk assets over the long term. Basically what that means is that the Fed and the government are working together really well to just inflate assets because they're going to print. And I'll actually have a video about that coming out soon, so subscribe if you want to see it. But the whole game has changed because the Fed has changed. They're completely different now than they were before and how they were for the past, 50 years. And once again, reviewing sentiment and positioning, sentiment is at a bullish consensus, meaning everybody is bullish. And like I said, that's a bad sign. And that's feeding into what's very fast becoming stretched positioning. People are way too long. That has created trend fragility. It's high right now, as we said before. Now, if we look at the charts, this is a monthly chart of the S&P 500. December was a very strong month. We saw follow through from November and we closed near highs. So we should see some bullish action in January, even though this trend is fragile at this point and the risk of a reversal is increasing. So if we get a little closer on the weekly time frame of the S&P 500, the market is continuing to work towards 3845, which is up here. That's about another 3% from where we are right now. So what are we saying here? Long term, the market is strong, the bull is intact, but short term, things are getting dicey. That's why our team in Macro Ops is expecting a correction mid-January. But the correction won't be a crash. It's going to be a 10 to 15% downward move. Kind of reset the sentiment, reset the positioning so that the market can continue on its longer term bull run. So we're expecting that mid-January, this month. But there's always a lot of things going on, especially right now. We have this transition of power coming up. We have the Georgia Senate race. We have more stimulus coming out. And we got a new COVID strain. So there's a lot of things playing out right now that could heavily tilt the odds in favor of the bulls or the bears. So we might see a much worse correction than we're thinking, or we might not see a correction at all and the market might shoot higher. That's why flexibility is key here. And this is why we keep updating things every week in these videos, because we're only weighing probabilities. You can't make a prediction. Things change too much. So you keep changing the probabilities as new information comes down the pipeline. Now, considering the flexibility in this market, there's another thing that's very important to understand as we trade these markets. And this is the advice I told you about that's coming from one of the best to play the game. And that person is Jim Paul right here in his book, What I Learned Losing $1 Million. He's a commodity trader. He said, what winning traders share is that they all understand that losing is a part of the game and they have all learned how to lose. Losing in the market, it's really important you know how to do that. And that's why I said in the beginning of this video, and I say it in every video, you're not an investment manager, you are a risk manager. And as a risk manager, you got to know how to lose. So I'll show you right here, our Fallible strategy ended the year with almost a 62% return versus the NASDAQ itself, which returned 47.5%. This is fantastic, especially on a risk adjusted basis. And what do I mean by risk adjusted? Well, to get this NASDAQ return of the 47%, you basically had to have all your money invested, all of it, and you had to hold the whole year. That's saying if you didn't have any strategy. This is just what the NASDAQ did, right? Now, if you have all your money in the NASDAQ, what is your risk? Your risk is that all your money is in that one, say, ETF, if that's how you're playing it. Now, in our case right here with this 62% return in our strategy, we were not fully invested the whole time because we are constantly managing our risk. We're taking profits, we're cutting our losses. So a lot of our portfolio is in cash a lot of the time. But still, even with the smaller amounts that we have in the market, because we're not fully invested, we still beat the market. So think about it. We're making much higher returns on smaller amounts of money. And that's how you could kind of compare risk-adjusted returns versus just straight up returns. Because there's a lot less risk when you're actually invested less money. But you can see, as we're showing here, you could still make a higher return. And it's just a much safer way to do it. And when a crash comes, you won't be screwed. Because what's the point of investing? You're not going to keep the money in there forever, right? There's going to be times where you want to take the money out. So if you're fully invested in like a NASDAQ ETF, then if the thing drops 50% during a crash and you try to take some out, that's a really bad loss, which is what happens to so many people during something like 2008 or 2000, those big crashes. But if you're focused on risk and you have a lot of cash on the side because you're strategically entering positions and taking profits and cutting losses, then you don't have that problem when things go bad. First of all, you'll never take that 50% drawdown in the first place because you'll sidestep the crash. And then second of all, you have all this dry powder and cash to either redeploy or take out during tough times or if you just want to use it. So that's the big meaning of risk-adjusted returns. And I talked about this in the last video, but I don't think I explained it well enough. If you're making bigger returns on less invested, you're way better off. And why it relates to Jim Paul here and his really smart quote, it's because to cut those losses and manage that risk, you got to know how to lose. It hurts sometimes. It really sucks. Just recently in our strategy, when we were around a 50% return, I think it was Moderna. Our system told us to buy into mRNA. And in the same day, it turned around and hit our stop point. And we lost a good chunk of money within a few hours. And it absolutely sucked. And a bunch of our Fallible members emailed me and saying, hey, I'm not going to use this strategy anymore. It must not be working. That was really stupid. So some people stopped using the strategy. But what I try to explain to them is that that is part of the game, taking those hard losses. losses. You don't hold on because that's not what your strategy says to do and you got to manage risk. But yes, it does suck when you lose that much money that fast. But what I was saying to them is that with a good strategy, with a solid edge that's been working for years, that works in every cycle, we're going to be just fine. And this is when we're already up 50%, right? Well, look what happened. Well, that trade maybe happened a month ago, right? And look where we are now. We finished the year up 62%. So we took that hard loss and still made 12% more. We went from 50 to 62. And that's where this psychology comes in and this ability to take a loss, because if you quit, then you wouldn't have had those returns that were coming right after that loss. Winning traders understand that losing is a part of the game. You got to learn how to lose. And this is just an important concept I wanted to share, because these markets that we're getting into for the next few years, it's going to be bullish, but it's going to be volatile. So you got to be able to manage that risk. And that leads me to the next thing that we're going to talk about, is the extremely popular stock that is something that you may not want to hold anymore because it's turning into a short candidate. Like I said, retail was so excited about this IPO. They all piled in. They all love this stock. Now the question is, who's going to sell and manage their risk? And that stock I'm talking about is Palantir. It's a retail favorite, as I said, and right now it's trading over 46 times sales. And its growth runway is not nearly as long as the market believes. And it's funny because Alex actually used to consult for them. Because if you know Alex's background, it's all in military and intelligence. If you ever watch those movies or that show Jack Ryan, that's Alex's life. At least that's how I imagine it. So he was a consultant for Palantir. And it was pretty cool over there. They have like Margarita Thursdays and everybody riding around on skateboards. A tech company. But like I said before, everyone was super excited about this IPO. It ran up a lot, but now it's forming a topping pattern. You can see right here, there's a support level that it's fighting with. So far it's surviving, but if it breaks this level right here, which is this 2360 or even a little lower, around in that area, it'll be lookout below from there. And you see it's already tested it before, but this is looking like a textbook topping pattern and you won't want to be holding if it breaks this support. Now, finally, let's talk about the huge trend that's coming, this decade-long trend, and we'll see how to play it. So at MacroOps, our research has been talking for a few months about digging into the old economy. You can see right here, as the new economy has outperformance, and we're talking about things like tech, capital moves away from the old economy, which is the boring stuff like oil or things with physical equipment that isn't just software. You see right here, things like mining, oil and gas, marine. Capital has moved away from them, so their investments in their own equipment and building stuff, that has dropped like crazy. Sustained declines in old economy capex. And this goes back to the capital cycle. What happens when there is less and less investment in the capital of these companies is that eventually the supply gets really tight because they're producing less and less. And this occurs because demand decreases, right? But as soon as demand increases again, the supply is going to lag because all these companies haven't invested in like building new oil rigs because no one wanted more oil. But as soon as that demand spikes, you're going to end up with a little bit of supply, and the supply is going to lag to catch up to meet that demand. So for a period of time, you're going to have high demand, low supply. And what's that going to do to prices? It's going to skyrocket them. And where that's about to happen and why we're talking about the old economy right now is because it's happening in commodities. So another thing adding to this increase in demand that we're going to see are the redistributional policies that we'll see with the Biden administration. So as money gets shifted to lower income brackets, that money usually goes straight into consumption instead of into the stock market like it does with the higher brackets. This is where people actually need money, so they're going to use it and spend it. And when they're spending money and buying stuff, the price of commodities goes up because there's more demand. You can see right here, the government paying people is this blue line, the dark blue, and then the commodities index is this light blue line. And you can see they trace each other pretty well. That's because the more money that the government gives to the people, the more they spend, and that pushes up the prices of these commodities because more demand. And as we said right before here, there's going to be less supply because they're not investing in it, and that's going to cause the price to shoot up, which is what we say right here. Greater consumption is going to meet head on with tight supplies. And there's tight supplies in a lot of things: cotton, crude, corn, gas, soy, copper, sugar, all things we consume. And then we'll even have La Nina this year, which tends to help commodity prices as well. So if you're looking for companies to play, commodity companies make sense. One of the ones that we're looking at is Mosaic, MOS. It's a potash producer and it's trading near its lowest price to sales ratio in history. And it tends to track the soft commodity cycle, which just so happens to be kicking off a new bull market because of what we just said, the supply and demand imbalance. So you can see this has been beat up pretty badly. So when it takes off, it can really take off. It has huge room. This is like more than 10x. But that's not the only stock we're tracking in this commodity boom. In fact, there's a whole nother area of commodities, specifically energy, where this same thing is happening. And this is even a longer trend. It's going to be multiple decades. So we've been looking at exactly which stocks to play it, and we're going to be able to make a ton of money on it. So if you want to see that research, click this video right here. Once again, we talk about the trend that is happening and of course the stocks we're going to buy to play it. So click this link right here if you're interested in playing it it, and I will see you in that video.